72%. That is roughly how much the price of silver increased during one of the fastest precious metals rallies of the past decade. And moves like that rarely happen without powerful forces building underneath the market. But today, a growing number of analysts are suggesting that the next phase of the silver cycle could be even larger, with some projections pointing toward prices approaching $300 per ounce. Situations like this do not usually appear out of thin air. They emerge when multiple pressures, financial, industrial, and structural, begin pushing in the same direction at the same time. First, I will show you how global demand for silver is expanding faster than most investors realize. Next, I will break down how the structure of the silver market itself can amplify price movements. And stick with me all the way until the end, because I am going to explain why 3 specific forces could combine to push silver far higher than most forecasts expect. Lean into this part. It's important, because the first reason silver could move dramatically higher is industrial demand. Silver is no longer just a precious metal held in vaults or turned into coins and bars. It is now a critical material used in solar panels, semiconductors, electric vehicles, and advanced electronics. Global consumption of silver now exceeds roughly 1.2 billion ounces each year, and demand from renewable energy technology alone has grown rapidly in the past decade. When industries require increasing quantities of a metal that is already in tight supply, price pressure begins building beneath the surface of the market. Keep this top of mind, because most people are missing this point. The silver market is relatively small compared to other global asset markets. Annual mining production hovers near 800 to 900 million ounces, and much of that supply is produced as a byproduct of mining other metals such as copper or zinc. This means silver production cannot easily increase when prices rise. When demand expands faster than supply can respond, the imbalance can trigger rapid price adjustments. At the top of this video, I told you I would show you how global demand for silver is expanding faster than most investors realize. The answer is that silver is being pulled by 2 powerful sources of demand at the same time. Industrial users need it for modern technology, and investors want it as a hard asset during uncertain economic conditions. That dual demand is what makes silver different from many other commodities. I need to pause for a moment because everybody gets this part confused. The second reason silver prices can accelerate is the structure of the futures market. A large portion of daily trading occurs through paper contracts representing silver that may never be physically delivered. When investors suddenly begin seeking physical metal instead of financial exposure, that paper system can become strained. Even a small shift toward physical delivery can create outsized price movements because the amount of paper silver traded often exceeds the available physical supply. Now consider the third factor that could drive silver toward much higher prices: monetary instability. Silver has historically served as a store of value during periods of currency uncertainty and rising inflation. When inflation persists while central banks struggle to stabilize economic conditions, investors often turn toward tangible assets. Silver benefits from this shift not only because of its monetary history, but also because it is accessible to both institutional investors and individual stackers. Taken together, these 3 forces, industrial demand, supply constraints, and monetary instability, create a powerful combination. When they converge at the same time, the silver market can transition from gradual appreciation into explosive price discovery. And if those pressures continue building over the coming years, the possibility of dramatically higher silver prices may become far less surprising than it appears today.